All right, we're all welcome back. Rounding up this particular program, we're going to be dealing with project budgeting. We're going to be dealing with project budgeting. We're going to take the next 15-20 minutes to talk about project budgeting. When we come back in level 2, we will look at project cost management entirely. Now, by introduction, every project, no matter how big or small, involves costs. Please, before I proceed, kindly confirm that you can see my screen and that you can hear me loud and clear. If you can see my screen, type 11. Okay, so for you to type 11, that means you can see my screen and can hear me. All right. So every project, no matter how big or small, involves costs. No matter how small, no matter how big. It's very rare to have endless piles of money at the ready. So having a planned budget for a project is a must. There is nowhere we just stock up money and say, the money is too much. So even the richest people on earth still budget. So budget is very, very important. As the project manager, you will be accountable for sticking to the budget. So you need to be sure it's right. If you undercall the budget, you will end up missing milestones, being understaffed, and having to do the work of shame to the finance department to ask for more money. If you overcall it, the project might not even get off the ground. So how do you get project budgeting right? Let's step through the process, starting with an overview of what the project budget is all about. So what is project budgeting? Project budgeting is determining the total amount of money that is allocated for the project to use. Project budget is the total estimated cost of completing each project activity over each phase of a project. A project budget template is a blank document that prompts a project manager to include a detailed estimate of all costs that are likely to be incurred before the project is completed. Project budget management is a process of formally identifying, approving, and paying the costs or expenses incurred on the project. Project budget management involves using purchase order forms to state each set of project expenses such as training, consulting services, equipment, material costs, and so on. So these are basic definitions. Now note, it's important as it helps set expenditure expectations and is crucial in getting project approvals, ensuring funds are ready at the right time, and measuring performance. It's a dynamic document continuously monitored, reviewed, and updated throughout the project. The project budget has been estimated by the project manager and/or the project management team. The budget is an estimate of all the costs that should be required to complete the project. We use the word should be because if a project is poorly estimated, then the project will require more costs. So that means the project manager and his team need to be very, very careful in project budgeting or project estimation. What are the benefits of project budgeting? By knowing how much money is available for each project activity, you can easily pinpoint areas that need attention. The project budget helps determine exactly what skills you need for what length of time, which is especially useful when people are working across multiple projects. The budget is an effective management tool to see if you are on track to meet goals. It helps prioritize activities that can be completed within the resources available. It helps promote future thinking and planning. Project managers who can deliver great outcomes while effectively controlling budgets have great career prospects. So if you want to improve your career prospects as a project manager, then make sure you are a good budget controller. Now, what are the components of project budget? We have basically two components. You have the labor costs, which involve all the costs associated with labor. For example, employee wages, benefits, payroll, taxes, and overheads, all the costs associated with labor. Then you have the material procurement costs, like goods, services, equipment, and every other thing that needs to be procured. Now, these two costs can further be divided into two broad categories. You have the fixed costs And then you have the variable costs. The fixed costs are the set of, these are the set for the project and will not change. They are set for the project. They are like it is fixed. They don't change. They are not completely reoccurring at all the times. Okay, so they are fixed. Most often they are one-off. They are not reoccurring. For instance, purchase of equipment is fixed. Securing compliance is fixed. They are not reoccurring. Maybe payment of tax is fixed. The percentage is fixed. You don't change it. Stamp duties is fixed. Okay. Let me ask, for those of us that do project budgeting, you've been privileged to do project budgeting before. How many of us do add the statutory fees to your project budget? How many of us do? You add statutory fees to your project. Let me see you type 55 in the chat room. You add those statutory fees like taxes and stamp duties. You add them. Let me see you type 55. You don't add them. Let me see you type 00. If you add statutory fees in your project budgeting, type 55. If you don't, type 00. Okay, can we do that very fast so that we can proceed? If you think statutory fees should be included in budgeting, type 55, whether you've done it before or not, but you think it should be included, type 55. If you think it should not be included, type 00. Okay, so I have. Okay, so you believe it should be included. All right, so when you are developing your budget, please ensure to add those things. However, you will find out that with some stakeholders, it becomes point of negotiation. They will want you to bear the risk of the taxes, bear the risk of stamp duties and all of that. What you need to check out then is, do you have enough management reserve to cover for those things? If yes, why not? You can give waiver to your stakeholders. But if not, then you need to explain to your stakeholder why those payments need to be done, all right? Or why those things need to be part of the budget. For the variable costs, this change based on the activity, so it changes of, all right. Engineer read one, please kindly unmute and let's hear from you. Your hand is up.
Yes, sir. Good afternoon, sir.
Good day, sir.
So I'm just thinking from my own point of view, I don't think one should, I as a person will not add statutory budgets to my own budgeting directly. I would rather calculate it and add it to my operational cost. So on that note, there is no need for the client to now start negotiating it with me. I will add it to my operational cost.
Okay.
So then I will move on.
Okay, thank you so much. I love that perspective. However, remember in the 12 principles of project management, we have the first principle that I spoke about, stewardship, and part of the things that make us good stewards as project managers is compliance. So showing your stakeholder that you comply with statutory rules or statutory requirements shows you as more of a professional, okay? But if you put it in your operations, please let them also know that, yes, your company will take care of the statutory fees. Then you mentioned that the statutory fees will be taken care of by your company. Meanwhile, you have indirectly included it in your operation, but let them know that you are giving them a waiver on the statutory fee, so you are having to bear the brunt of the statutory. Let us always mention or pay attention to cases of compliance because they are very, very crucial and critical. Okay, I've actually been on a project before, and I did not include statutory fees. And they asked me a question: what about the tax? Who will pay the tax? I now have to tell them that, okay, for the task, we will take care of the task. That's why we didn't include it. But meanwhile, it didn't cross my mind when I was developing that budget. Okay, so it's good for them to know. Okay, it's good for them to know. All right, thank you so much. Now, moving forward, we have project budgeting method. We have the first one, we have the analogous estimating. Just as the name is, analogy, drawing comparison. Okay, you're raising budget based on comparison. Maybe you have a project B similar to a project A that was done somewhere. You now begin to compare the scope, compare the schedule, compare the quality, and then from there you can then come up with a budget. However, we don't consider analogous estimating to be a very adequate method or a very accurate method for budgeting. Then you have the other one we call the parametric modeling. The parametric modeling more of consists of using data, historical data, and other related variables for estimating the project scope, duration, and total cost. So those historical data are searched out. It could be from current data from the market. It could be survey information. It could be things or data you've generated. You know that these data are valid, not just by making comparison, but you have valid data to come up with the project scope, the duration, and the total cost. All right, so somehow it is much more accurate and most preferred when compared to analogous estimate. So in parametric estimate, you have your data to make your justification. But in analogous, you're only making comparison. Oh, this work is 3-bedroom flat. That one we did was also 3-bedroom flat. This one have kitchen and dining 3. This one will also have kitchen and dining 3. So you do plus and minus and then give your rate. There is nothing unprofessional about it, but it's better you have facts and figures that will help you make the most accurate decision. Remember, project management is all about making the right choices at the right time with the right resources. That's the most important thing, so that we'll have the right deliverables. Okay. Okay, so someone is asking, how do we do parametric estimating in current economic climate in Nigeria, where prices change constantly? Okay, so you already know that prices change constantly. Okay, that enough is a good hint on now to find out what is the inflation rate. Okay, what is the cost changing rate? That cost changing rate becomes a basis you can use to make parametric decisions. You already have a data. Is it 4%? Is it 4.5? Is it 12%? Is it 10%? Then you could also look at the trends. Last month we had 4%. This month we had 3%. Last month, in the other month we have this. By the time you take some statistics, you can then come up with your mean, come up with the average deviation, and then you could use your own forecasting. Remember, there is a difference between analysis and analytics. There is a difference between analysis and analytics. Analysis is reviewing past information, reviewing past data. Okay, reviewing past data. Analytics is reviewing data for future use. Why analysis is breaking down data and then reviewing it and coming up with representation of the data. But analytics move beyond representation to having to make decisions, future decisions with those data. Now, when you have trends on how the economic changes take place, it provides you basis for analysis. So you could come up with your mean, your you could come up with your what we call the is it centers of what they call it again? Central tendencies. Okay, you have modes of central tendency. So you could come up with your mean, you could come up with your mode, you could come up with your median, and then that alone could give you information on how to use the data on your calculation. So if you see a deviation, you could use that to calculate for, move the analysis to analytics. That's if the project is a future project, then you can bring the analytics part of it. And then you have some tools in project costing that we call to complete performance index. I think there was a place we mentioned some of those things to complete performance index. So you could have future forecasting using to complete performance index. When you have to complete performance index over a duration that you have established, and then you have your trends that you have used in calculating your deviations and all of that, then you can come up with a figure that is much more sizable. And then when you're presenting your information now, your stakeholder, he or she can ask you, why is this thing different? The last time I checked, the cost of this was 20,000 naira. How come you're budgeting 29,000 naira? Then you can bring out feasible data, give him or her your trends you've come up with, the calculations, the data you've gotten, and the analysis you've done with the data that helped you make some analytical decisions. And the person will have no problem with that. Okay. Let me put this off the record. This one is a personal experience. But you with parametric is easy to use, and everybody can use it because that's the most feasible, most reliable. Now, another one is the one we call the top-down method, just as it is top-down. So you have the total costs or the total budgetary anticipation, and then you begin to break it down from the top to the down. Okay, you begin to break it down. So you just said, how much is the project? It's 400 million without calculating anything. And then when the money is now released, you now begin to okay, phase one, you now begin to break it down. This also is not too good for projects. Okay, it's not too good for projects because you might not be able to come up with the most effective costing as of that time. Okay, then the next one is the bottom up. So the bottom up, you started from the list, you calculated from the list up to the highest. This is more effective than the top down. Okay, so bottom up, you started from the list and you calculated up to the highest, and then you could then submit what your budgeting is like. Okay, all right. Then you have the 3-point estimate. Okay, I just gave an example of the 3-point estimate. Okay, the 3-point estimate, you can use 3-point estimate to arrive at the bottom up, the top down, the parametric analogous. You could use the 3-point estimate to achieve any of the other ones, right? Now, it's just to take data, at least 3 data of similar projects, similar costings, similar schedule, and then do your what we call you do what we call the 3-point analysis. What we call it PERT, Program Evaluation and Review Technique. Program PERT, Program Evaluation and Review Technique. When you put it in a graph, it becomes Graphical Evaluation and Review Technique, GERT. Now, when you are running a PERT, you have the 3-point estimate. You use the 3-point estimate to come up with your PERT, right? Now, for PERT, you have what we call the TE. You could write the formula down. Let me get the formula for you. You have the TE. Sorry, let me better off use something. Okay, so you have TE is equal to TO plus 4TM plus TP, all of this divided by 6. divide all of these by 6. So this will give you your PERC or your 3-point estimate. 3-point estimate value. Okay, so this will give you a 3-point estimate value. This will give you a 3-point estimate value. So how does this apply? So let's take, for instance, you want to create a schedule for your project. Perhaps a project you have done in time past, right? And then you want to create a schedule for that project. So let's assume it's construction of 3-bedroom flat, for instance. And then you have your TE here means the expected. Your TO means the optimistic. Your TP means the pessimistic. So you have 3 variables, pessimistic. You have 3 variables to help you determine your schedule or your cost or your scope. So you have, for instance, you have a project that you want to do, but you've done a project of such before, or you have data on projects of such that have been done before. So you have 3 elements on the project. So, okay, you have your TM. I didn't talk about TM. You have your TM, the most likely. So coming back, you want to develop a duration for a particular project. So you have template A, similar template that told you that this project took maybe 305 days. You're constructing 3-bedroom flat. It took 305 days, assumedly. Please, this is not an actual data. I'm just coming up with something. So the first one took the 305 days, and then the second data took 316 days, and then the last data took 405 days. Now, to come up with your TE, your most expected, we will assume that your optimistic will be the smallest, which is 305, plus your most likely is not the highest, it is not the smallest. So we have 316, that will be 4 times 316. So we want to have the 316 having more coefficient, since it's going to be the most likely. Then we have 405. All of this divided by 6. So somebody calculate for me and let me have your answer. Please, can you calculate this very fast and let me have your answer? So what is our TE? What's your answer? Do I have any answer? Where is the fastest finger? 305. First of all, 4 multiplied by 316 plus 305 plus 45 divided by 60. Okay, so someone said 329. So can I confirm that again? 329. Can someone confirm that? 329, 329. Someone confirm so that no other confirmation. So let's assume it's 329 since no other confirmation. Now, what has this done for us? The 3-point estimate has helped us develop a total duration. There is not the least, there is not the highest, okay? What this means is that while doing this project, we can check out for what made this project fast at 305 days, and then check out what made this project at 316, and then check out what made this project 405. And then we can decide that's okay. For the pitfalls that 405 and 316 witnessed, we don't want to have them, and then we eliminate them and focus on the most important one. Okay, so this is how 3-point estimate works. You can still use this for your costing. So let's assume that at 305, we used 14.5 million. Let's assume that we use 14.5 million. And then at 316, we use 16 million. And then at 405, we used 30 million. Now, if I want to calculate the cost of this also, I could have the most likely. So I have my TE. So I have 14 million or 14.5 million. Please, you can calculate before I finish. Plus 4 times 16 million. If you want to see this money in your account very soon, just be calculating. Plus 30 million. All of these divided by 6. So for a 3-bedroom flat, this is we're just assuming we want to bring up a cost, but we want to use historical information. We want to use historical data, come up with a figure. So how much will this be? How much will this be? Is someone with me? How much will this be? Is someone punching calculator? Okay, so someone say 18 million. So we could have TE 18 million. This is your least expected income for this year. So before this year runs out, your income would have multiplied by at least 18 million. So this is our expected figure for this assumption. But before this year runs out, you will have enough. You have enough. Okay, do I have any question here? Do I have any question here? I've explained how to use TE. I've explained how to use a 3-point estimate. Okay. And if we want to, let's assume we want to take a parametric analysis on this right now. Let's assume we want to do parametric. Okay, so we already have this data. Okay, let's assume we have 3 projects we've done in the last 5 years. Okay, 3 major projects we've done in the last 5 years. So let's assume that this is the first year, this was the 3rd year, and this is the 5th year. Okay, 305 for the first year, 316 for the 3rd year, and then 405 for the 5th year. So all we want to do is come up with an index. Okay, we want to come up with an index to tell us the degree of variation. Okay, so you may have to calculate the degree of variation from 305 to 316 to 405, right? When you have your degree of variation or the index, variation index, you can then multiply that variation index with the current reality. So this is the most recent one. If we have the trend for the past 5 years, then we can say, okay, let's assume that at the end of the day, we have variation index of 0.2. Then we can say 405 multiplied by 0.2, but I'm sure this is way beyond, it's way beyond 5. By the time you calculate it, it's more than 5. Sorry, 0.5 rather. So if I multiply this by 0.5 and then add it, I can come up with something much more realistic. Okay, much more realistic. Okay, so do I have any question before we proceed? Any question for the Son of Man? Question, please. Please feel free to ask me a question. This is money matter. The most crucial part of project management. Any question for me? Okay, so if there is no question, let's proceed then. Now, in summarizing, I believe you can still see my screen. In summarizing, okay, then we also have the end value analysis, which more of is the end value is you review the amount that was initially budgeted versus the amount that has been spent. That is what end value analysis does. So end value analysis is a way of checkmating costs. It's not really about developing costs, as it were, but you can use it to monitor and evaluate your budget. So you review what is being spent versus what was planned to be spent. Then from there, you could know the variance, okay? Now the budgeting process, what are the steps in budgeting? Number one, determine your scope. Number two, determine or develop your WBS. Number three, determine the activity durations. Then number four, determine the resources for each activity. Then number five, determine the total sum. That's the cost of each of those resources, and the cost of the activities to be done. Sum this amount up, and then determine your management reserve. By the time you add everything together, it will give you your budget. Determine your project scope. Break down your project scope into deliverables, into WBS. Then from each of those content of WBS, assign a duration. From each of the duration, assign resources. Come up with the financial estimate, the cost estimate for each of those activities. Calculate the total sum of each of those resources, and then determine your management reserve. Calculate everything together, sum up everything, then you have your budget. Okay. Do I have any question? This is just an example of a project budget. We've already sent anyway in the classroom, but we still send it again. So this example of a project budget, you have your WBS here under the task. You have your WBS. You have your labor hours, that's your resources, your labor, your materials, equipment. You have all of them here with all the costs associated with them. So you have the budget for, or the cost for each of these levels. And then by the time you calculate everything, you have what we call your total budget. So you have your total budget here. This is your budget. This is your actual. This is your deviation. That means this, for this particular template, the work has already started. For you to have seen the actual work, the actual amount that has been spent, and then the remaining that is to be spent, compared here. So with this, you can then calculate your end value. Your end value will be what was budgeted versus what was spent. Are they tallying? If they are not tallying, then you could find and say, okay, there is variation. Okay, you can now talk about cost variance. Okay, you can talk about cost variance, the difference between what was planned versus what is spent. And cost variance could be positive or negative. If it is positive, good. If it is negative, something is wrong somewhere. Okay. And we'll often say that when you have cost variance of minus, negative cost variance is often not recoverable. That means it is spent. And if care is not taken, it may involve dragging people up and down, which you don't really want. Okay, so to ensure that your project is on track, please make sure your monitoring and evaluation on project budget is also on track. Now, for your group activity, you are to develop for your group project, your WBS, your timeline, and your budget. So those are the things you're going to add to your project work. And then after that, you humbly and kindly submit. In conclusion, budgeting is hard, but worth the effort. Managing the project budget is probably the most difficult part of project management, but also the most important. Even if you deliver the most brilliant outcome, right on time, it counts for nothing if you've overspent. So let that sink into our head. At this juncture, I will say very big thank you. I will open up for questions. If you have questions for me, if there is anything you did not understand, the three sections we've taken, they are all hands-on. So we provided you with templates. We explained and we provided with templates. So there are things you can easily work with. Okay, so if you have a question, please ask me now and I will take all. Thank you so much.